Hello, welcome to NS channel. At the beginning month of the financial year, HR or finance department of a corporate asks its employees to decide which tax regime they would like to go for, either old or new. Since the default tax regime is new tax regime as per the Income Tax Act, it appears that the new tax regime would be an obvious choice, but we don't want to follow that popular view. We want to see for ourselves which regime makes more sense. Now let us see the analysis. Before going into the analysis, let us have a glance of the income tax slab under the old tax regime for the assessment year 2026-27. Income tax slab applicable under the new tax regime for the assessment year 2026-27 is given below. Key tax saving avenues in the old regime, that is the exemption and deduction allowed under the old regime. The standard deduction under section 16(1)(a) up to a limit of 50,000 for salaried individuals. Then investment in equity linked savings scheme, employees contribution to NPS, premium towards life insurance policy, deposit in tax saving fixed deposit, contribution to employees provident fund, public provident fund, and purchase of national savings certificate, deposit in senior citizen savings scheme and Suganya Samriddhi Yojana scheme, principal payment towards housing loan, all put together under section 80C and 80CCD1 up to a limit of 1,50,000. Contribution by the employee under the NPS Tier 1, Section 80CCD 1B up to a limit of 50,000. Contribution by the employer towards NPS under Section 80CCD 2, 10% of salary, that is basic pay and DA. Then premium payment towards health insurance under Section 80D, 25,000 rupees for those below 60 and 50,000 rupees for those above 60. Then interest on repayment of loan, both let out and self-occupied, under Section 24 up to a amount of 2 lakhs. Interest on savings account for those below 60 years under Section 80 TTA up to a limit of 10,000. Interest on savings and fixed deposits for those above 60 years, Section 80 TTB up to a limit of 50,000. Leave travel allowance under Section 10(5) as per computation for a 4 years block of 2 financial year. House rent allowance Section 1013A as per the computation formula. Food wallet or food allowance under section 17(2)(8) rupees 2,200 per month. A donation under section 80G up to 50% or 100% of donation depending on to whom the donation was made. For the disabled dependent persons, for the normal disability from 40 to 79%, it is 75,000 rupees, and for the severe disability, that is the disability percentage of 80% or more, it is 1,25,000 is allowed under section 80DD. Medical expenses incurred on specified diseases, section 80DDB, for 40,000 rupees for those who are below 60 and 1 lakh for those above 60. Deduction for disabled person under section 80U, 75,000 rupees for 40% disability and 1,25,000 for 80% disability. Key tax saving avenues in the old regime continue. Professional tax paid up to 2,500 rupees under section 16(3). Children education allowance received 100 rupees per month for up to 2 children under section 1014. Hostel expenditure allowance received 300 per month for up to 2 children under section 1014. Housing loan interest 50,000 rupees under section 80EE but subject to certain conditions. Housing loan interest up to 1.5 lakhs under Section 80 EEA, and the loan should have been sanctioned between 1/4/2019 to 31/3/2022. Interest on loan for electric vehicle purchase 1.5 lakhs under Section 80 EEB. The loan should have been sanctioned between 1/4/2019 to 31st December 2023. Transport allowance received 1,600 rupees per month under Section 1014(2). Transport allowance received by a disabled person 3,200 rupees per month under Section 1014(2). House rent allowance 5,000 per month under Section 80GG where HRA is not part of salary or a self-employed person. Interest on educational loan under Section 80E for 8 assessment years. Carry forward of house property loss under Section 71B. Carry forward of house property loss can be set off against income from house property for 8 years. Tax paid by employer on non-monetary perks, Section 1010CC, the amount of tax paid by the employer on perks. Key tax saving avenues common under old and new tax regimes. Standard deduction under Section 16(1)(a), 50,000 rupees under the old regime and 75,000 rupees under the new regime. Transport allowance for disabled, Section 1014(2), 3,200 rupees per month. Interest on home loan for let out property under Section 24B, limited to the taxable rent received. Employer contribution to NPS account, Section 80 CCD2, 10% of salary, that is basic pay plus DA, under the old tax regime, 14% of salary under the new tax regime. Standard deduction on family pension under Section 57(2)(a), one-third of family pension or 15,000, whichever is lower under the old tax regime, one-third of family pension or 25,000 rupees, whichever is lower under the new tax regime. Exemption on voluntary retirement under Section 1010C, 5 lakhs maximum. Leave encashment received on retirement under Section 1010AA, 25 lakhs maximum. Gratuity on retirement under Section 1010A to B, 20 lakhs. Conveyance allowance under Section 1014(1), official work related to the travel allowance. Life insurance maturity amount under Section 1010D, the amount of payout. Long-term capital gain on equity-related assets under Section 112A up to a limit of 1,25,000 rupees. Commuted pension on retirement, Section 1010A, commuted value received. Old tax regime versus new tax regime. In the table given here, I have mentioned under which tax regime the tax liability will be less across multiple income groups starting from rupees 4 lakh to rupees 50 lakh with the value of exemptions and deduction required under the old tax regime against each income group to have a choice to select the tax regime. For a taxable income of rupees 4 lakh to 5 lakh, for any amount of deductions and exemption under the old tax regime, the tax liability is same under both the regimes. So you can choose either old or new tax regime. Similarly, for taxable income ranging from rupees 6 lakh to 12 lakh, new regime is favorable for certain value of deductions and for other value of deduction you have a choice to choose. For an income of rupees 13 lakhs, the deduction from 0 to 4 lakh, the new regime is favorable. For a deduction of rupees 4 lakh 87,500, You have a choice to choose either the old or new tax regime. For a deduction from 5 lakh to 8 lakh, the old regime is favorable. If the taxable income is 14 lakhs, the new regime is better if the allowances and exemptions under the old tax regime varies from 0 to 5 lakhs. If the deduction is from 5 lakh 50,000 to 8 lakh, then the old regime is a choice. Similarly, for an income of 22 lakhs, the deduction varying from 0 to 7.25 lakhs, the new regime is better. For a deduction of 7 lakh 50,000 to 8 lakhs, the tax liability under the old regime is less. For a taxable income varying from 24 lakhs to 50 lakhs, for a deduction varying from 0 to 7.5 lakhs, new regime is a choice. For 7 lakh 75,000 rupees deduction, either you can choose old regime or the new regime because the tax liability is the same. For a deduction of 8 lakhs, the old regime is better. Under either one choice, in selecting the tax regime, you have to keep in mind that by choosing the new tax regime, you cannot carry forward and set off house property laws for salaried individuals and business laws for individuals having business income. The deduction required in the old tax regime for it to be more beneficial than the new tax regime have become quite high now, that is up to 8 lakhs. But don't go beyond that 8 lakhs because beyond 24 lakhs of income, the tax rate in both the old and new tax regime are the same at 30%. Points for consideration before choosing the tax regime. Disposable income. New regime will substantially increase the disposable income available to both middle class and high income earners. The benefit will be more felt by the low income earners with no tax liability up to 12 lakhs. Household will have more resources to manage expenses like education, home loan EMIs, and healthcare. Flexibility in investment. The new tax regime offers the flexibility to the taxpayer to invest their money as they prefer. There is no obligatory requirement to invest in specific tax saving scheme and insurance plans which may not be in alignment with their financial goal. By this, our investment will not get restricted to specific schemes with low payout. Absence of automatic mechanism of cultivating saving habits. Old regime benefit young earners to build saving. Increased savings assures financial security for the old age and in times of need. The old regime increases long-term wealth creation by providing tax benefits on investments in instruments like the Public Provident Fund, National Pension Scheme, and Equity Linked Savings Scheme. High income and middle income earners, high net worth individuals also benefit from the old regime if deductions and exemptions of more than 8 lakhs is possible. Middle income earners may feel better to go for new tax regime if they are unable to manage with deductions through tax saving investments. Free from documentation. New tax regime is simple and hassle-free since there is no need to produce documentary proof for deductions and exemptions which has to be produced by salaried individuals to HR or finance department. Points for consideration before choosing the tax regime. Both old and new tax regime have benefits as well as drawbacks. Before deciding, understand the differences between the old and new tax regimes. The previous tax structure instills in a taxpayer the habit of saving. The new tax structure benefits employees who earn less and invest less, resulting in fewer deductions and exemptions. Higher deduction under the new tax regime. For employer contribution to National Pension Scheme under Section 80 CCD 2, 14% of salary is allowed compared to 10% under old tax regime. For family pension under Section 57, rupees 25,000 is allowed compared to rupees 15,000 under old tax regime. Hence, while computing the additional deductions under old tax regime in the above table, the effect on this account should also be considered. In the new tax regime, carry forward and set off losses is not allowed in respect of house property loss. In case of individuals having business income, they cannot set off the business losses as well as the unabsorbed depreciation. While taking a decision on the tax regime, consider income from other sources like interest, dividend, capital gain tax at the slab rate, and special rate since it will have impact on the choice of the tax regime. In addition to salaries, if you have a good income from other sources like capital gain, interest, dividend, etc., it is difficult to estimate the income before the end of the financial year. Hence, it is better to opt for higher TDS under the old tax regime to avoid paying tax with interest at the time of filing. Thank you. Links are provided here for my other videos for your view. Please don't forget to subscribe to my channel by pressing the subscribe button. It will give me encouragement to post more videos on taxation and investment planning in future.